Hello and welcome to Economy and Markets TV, the show that takes you around the world of economic and financial news. I'm Dave Okenquist, Senior Research Analyst here at Dent. It is time for our news recap of the week, which means I welcome Rodney Johnson, the Senior Editor and Co-Founder of Dent Research. Rodney, welcome back.
Hey, Dave. Good to see you. In
case anyone is new to this show, we like to highlight just the most important items of the week that we think, and we try to keep things moving a bit. We try to keep each topic to about 2 minutes or less. And if Rodney goes over 2 minutes, he will hear this sound, which is the bell that will ding him to say, hey, man, you're just going way too long here. We need to keep people
move along.
Yep. To move it along. Yeah. All right, so with that, let's just get right into our first topic. The biggest news of the week was the Fed raised rates by 0.25%. And not only that, they expect 2 more in 2018, which brings it to a total of 4 for the year. Rodney, we've seen prices rising. We're seeing some indications that there's some growth in the economy. So did this rate hike make sense?
It makes sense, certainly, from what the Fed wants. Remember, we were sitting at a rate of 1.5 to 1.75% on short-term rates, which is very, very low, below the rate of inflation. And so the Fed wants to get back above that. They want to get to something normal so they have some ammo the next time the economy rolls over. What was very interesting is this change from, as you noted, they expect not 3 rate hikes, but 4 rate hikes this year. Now, when you peel the onion a little bit, it's not as clear cut. There are 15 voting members, and it's not like 15 of them said, you know, we thought it was going to be 3, but now we say 4.
Okay.
It actually was 7 of them in March who said we expect 3 hikes, and now it's 8 of them that expect 4 hikes. And so, oh, wow, one banker changed his mind or, kind of moved a little bit. Not a big thing, but it is a thing. And so the fact that they expect 4 rate hikes, which means we'll get another one here, another 2 here, would put us up from 1.75 to 2% to 2.25 to 2.5 by the end of the year. Okay. And yeah, that's a change. Look at how long it took us to get here. I mean, it's been 4 long years of slowly doing this. And so we are getting back to normal in the U.S., and so it does make sense.
No, but this could change, right? As we've seen, things are flexible. I mean, Chair Powell doesn't seem quite as much as Chair Yellen was with this data dependence and sort of squirrely answers. But it seems like there's a clearer direction here. But that can change, right? I mean, we might
right. They remain data dependent, as they say. And so if they get different information or see a market slow down in the economy or something, they can definitely say, hey, we're just not going to do it. And so they can certainly change their minds. But it's interesting that they gave this forecast. And to your point, looking at GDP and the Atlanta Fed GDP Now model that you and I look at shows GDP growth over 4% in the second quarter. Well, the Fed's annual model for this year shows about 2.8. And so they expect the economy to slow down dramatically in the second half and remain under 2.5 next year, down to 2 the year after, and really about 1.9 after that. And so they're not looking for the economy to grow gangbusters, that's for sure.
Yeah. Well, just one quick comment here from me before we move on. That tells me they don't believe the 4.8% number. That's what that tells me.
Well, they might believe it for just these 3 months, but remember, this has tax cuts into it. It has the corporate tax reform, stock buyback. It has a lot of things built into it that won't be repeated.
Yeah, absolutely. All right, let's move on to our next topic, Rodney. Retail sales rose 0.8% in May, and even higher than that, 0.9% when you strip out autos, which to me is pretty important because autos make up about 20% of all retail sales. So when they go up and down, it tends to move the pile a lot. Yep. Just to that point, general merchandise, which includes department stores, they were up 1.2%. Rodney, is this tax cuts? Is it general economic health? Is it just 1 month? What's going on here?
I think it's tax cuts. I think what we're seeing here is the tax reform putting a little bit more money into people's pockets. The unemployment rate is low. You're seeing the minimum wage tick up in a lot of different places. As you know, you hear that minimum 15 and some other things. Yeah. And so people are definitely spending a little bit more. The question is, how long does it go? We always expected a pop. We're getting the pop. And so are people going to continue that and spend more and more and more? I don't think it's going to be like that. I think this kind of broad kind of increase here, and then it kind of fades into the third and fourth quarter.
Yeah, absolutely. Yeah, I mean, I don't really have any much more on that topic. I appreciate that. So if you're ready to move on to the next one.
Sure.
All right, great. So that one is we talked about the Fed. So moving across the Atlantic to Europe, the ECB held rates at minus 0.4%.
Right.
This just makes me laugh because here we are, the U.S. raising rates, and then the ECB is just keeping them negative. Anyway, they just to move this along here, I'm going to ding myself. They said they're going to keep the bond buying in place, but then they're going to reduce their purchases in September by half, and then end it in December. Seems like there's a real decoupling going on in the U.S. and Europe, which is, I guess, has been going on for longer, but it's becoming more obvious now, Rodney. Isn't that the way these central banks are treating their economies?
Absolutely. And so the ECB is, of course, remained involved. We not only stopped our bond buying, but we are reducing our central bank's balance sheet every month, and we're raising rates. They're still buying 30 billion a month, 30 billion euro a month, about 34 billion dollars a month of bonds. They're going to cut that in half in September, and they say they're going to end in December. But as you noted, they're going to hold their deposit rate at negative 40 basis points, at least until next summer. And it's all about their economy slowing down. They had decent growth for, what it has been over the last 10 years of around 2.5%. But now that's coming back. And so you have to look at it and say, well, what is the long-term structure of Europe? And it's old. There's no, surprise here. They are an aging economy. And so you don't expect them to be growing in any significant way. And that's what you've got. What they're based on is exports by the strongest economy being Germany. And when that slows down, which it is right now, by the way, then they have a problem. And that's going to basically, peel back the mask on the bigger problems in the European bloc, which is that the countries move at different rates. And as long as they're tied together with a central currency, they don't have the ability to adjust individually. And that causes the problems like you see in Greece, that you had in Portugal a while back, although they've come out, in Spain, and of course now Italy is the one at the fore. Eventually, this causes big problems, and I still expect the euro to be a failed experiment.
Yeah, that point about exports, I can see why when the U.S. maybe threatens to put tariffs up. I mean, if the export engine is driving Europe, then I could see why they scream bloody murder at the very suggestion of a trade barrier. Other thing, so do you think, okay, so I think in a copy you said they're throwing in the towel. Do they know that this is, are they aware that maybe this thing isn't going to last? Do you think that's in their minds when they're making these decisions? I
don't think so, because, again, the failed experiment is not the euro dies like you and I think of it. It's not as if they say, okay, let's just not use it anymore. The Italians go back to the lira, the French go to the franc, the Germans go to the mark, that kind of thing. Instead, what I think happens is they build other artifices onto it so that it can continue as a central currency, but it gives individual countries a way to react to their individual needs. And so I think what happens is they water it down somewhat to make it palatable. Because remember, the European experiment as it is put into place so they stop killing each other. Yeah. And it worked. That's a really good thing. We don't want them going back to wars, which is what they had for all of time until, of course, after World War II. Yeah. And so to keep that economic closeness together so that they're tied together and they don't get into a war, that's a great thing. I mean, clearly. And so, but the way they've done it today is too strong. That's the problem. And so I think we'll see a weaker version.
Okay, great stuff there. Let's let this topic run a little bit longer because we were short on retail sales, so that's great. Let's move on to our last one. We've got news on Bitcoin. Bitcoin crashed a bit, and along with other cryptocurrencies, following this University of Texas study that says the Bitcoin exchange, I believe it's Bitfinex, if I'm pronouncing that correctly, pretty much just manipulated this whole run up to 20,000. Bitcoin's now sitting at about 6,500 as of right now. Well, this doesn't surprise anybody, does it, Rodney?
No, it doesn't. The question is how widespread or rampant is it? Because it's a digital currency, it can be pushed around. And so Bitfinex is the largest trading platform. It's also not regulated. And so the idea that Bitfinex, which issues its own currency, the Tether, would issue currency whenever Bitcoin started to fall, and then Tether was used to create a bid for Bitcoin pushing it up. That has people going, wait a second, how manipulated is this currency? Oh, there goes my phone. And so then they ask, how manipulated is the currency, and is it just one big Ponzi? And so that is the question. And so one of the things that had driven Bitcoin at the end of the year last year was the idea that institutional investors were coming in. You were seeing big names creating trading desks. Maybe JP Morgan was going to get involved. Goldman said they were going to do something. And so that was bringing really, good names to the table. Yeah. Well, those people are going to look and say, if it's manipulated, I don't want to touch it. And so that's the problem, is it gets rid of the idea that these very large players are going to come in and be a part if they think there's anything illegal about it, because frankly, it wouldn't make sense. Yeah. On the flip side, Bitcoin and Ether got some good news at the end of the week, where they were told by the SEC they're not a security like a stock, which gives them a pass in being regulated by the SEC. It doesn't mean that they won't be regulated, and it doesn't mean that they're not an asset, so they have a tax consequence every time you use one, buy or sell. But it does mean that the SEC is out of the picture for just those two.
Yeah, certainly they're stepping out of the way. And of course, as we talked about prior, you still have that nice tax liability for all of these things.
Exactly.
Yeah, so the other thing, I didn't realize, I thought there'd be manipulation. What I thought when the price of Bitcoin was falling, just to go back just a little bit, I thought it was people that were heavily invested trying to pump it back up. I really didn't think it was something like an exchange doing this squirrely stuff. So yeah, I could see why, major institutions are like, no, I don't want a part of this.
Well, and you get into the other things too, as being digital. Remember, we had that $500 million digital theft earlier in a cryptocurrency. And so we have these thefts go on because they are digital that are, 50 million, 200 million, and then $500 million. It's so easy once you find an open door electronically to siphon all the value that it really becomes the Wild West. And it makes you wonder why people want to get really involved in something that clearly is not too secure and can be manipulated. But as they say, other than that, it's perfect.
Yeah, exactly. All right, thanks, Rodney. Looking ahead to next week, we've got some stuff on housing. We've got housing starts and existing home sales. Other than that, it's pretty light. Rodney, anything else you're looking at next week?
No, it's going to be the tariffs that, of course, President Trump put on here at the end of the week. And if we get some closure or change in those, or if we get a retaliation. And so given that with the light calendar, I think it's going to be all about tariffs.
What was that, about $50 billion? Is that what we heard this morning?
Yeah, $50 billion in products, and I believe it was a 25% tariff.
Yeah. All right, great stuff, Rodney. Rodney, that's all we have, so we're going to wrap up here. I want to thank you for joining me. As always, I want to thank you all for watching, and we'll see you next week.